My name is Dan Wolfe. I am the co-founder of the Simoleon Long-Term Value Fund, which is a cryptocurrency fund. And this is Christian.
Yeah, I'm Christian. I'm a partner at Firstchain Group, which is a Singapore-based group where we help family offices get exposure to blockchain technologies. I'm also a partner at Swiss Founders Fund, which is an early stage VC out of Switzerland, and I'm also a limited partner in Polychain Capital.
So I'm going to turn the questions that were asked in the description of the panel on their head. We'll start out by talking about what high net worth investors need, and in part I think the question is, should they be in crypto at all, and if so, how they should structure their investments into it.
Yeah, so over the past 12 months, we've been working very closely with family offices that want to get exposure into the space, and family offices traditionally have been set up by wealthy individuals and families that have usually some exposure in certain industries. They've been entrepreneurial families over decades, but they have very good market access and an understanding in certain industries, but they don't really know what blockchain technology is, what is coming their way. They understand that blockchain might impact to some extent their traditional businesses, and they want to get exposure to this space. And they're looking for ways to engage with, with founders with this new technology, and we help them to achieve this. And I think there's like different ways how they can do this by, having sort of round tables, and we've organized these kind of round tables with, traditional entrepreneurs and now also startup entrepreneurs that build something on the blockchain technology, but then also by simply investing into company and act as advisors to these companies by giving them market access because they have the ties into the industry that most of these blockchain companies don't yet have. So I think it's both. It's from like the financial point of view. They can just have like financial exposure, reap the benefits of hopefully accelerating prices, but then also just advice and get sort of a knowledge exposure to this space. How do you see this?
Yeah, I agree. I think one of the things that's very interesting in my interaction with investors is they not only want to seek returns by investing in cryptocurrency and cryptocurrency funds, but they're also trying very hard, especially the high net worth individuals, to understand how will blockchain impact the world, how will it change the industries that they may be primarily invested in. And so there's a kind of an interesting combination between looking for returns, which obviously any investor is looking for, and trying to understand things. So I think it's very interesting that you help them get more deeply involved. And by the way, in my experience, one of the best ways that people can start to understand anything, including Bitcoin or any other cryptocurrency, is to go long. As soon as you own it, you start understanding and noticing when it gets more expensive, when it gets cheaper, why it might be, and I think that's a very powerful thing. One of the questions that I thought we might also ask for high net worth individuals is, as many of you have probably noticed, it seems like every fourth person is setting up a cryptocurrency fund. So one of the questions that I wanted to ask the panel is how would you recommend that people analyze the different offerings that are out there? Because there's quite a lot of them, and it's a bit of a challenge.
Yeah, it's true. I mean, I became an LP in Polychain Capital in December 2016, and then there weren't too many options out there, right? So I think now it's like any other hedge fund that you can become an LP, and you compare basically the offering also based on sort of like the terms. Right? I think the 220 model that was established that is still around. I think it's becoming more and more competitive. There's higher cliffs as well that need to be met, and there's also tokenized funds now that you have some sort of like secondary market and you have liquidity of your fund contribution, so there's less lockup periods. I think it very much depends on sort of your investment appetite, how long you want to be part of the journey, I guess. Also, is it sort of a reputable firm, or is it maybe a first-time fund manager? So there's I think different factors that weigh in. I think the downside of actually investing into a hedge fund, a crypto hedge fund, is you don't actually get that exposure, right? So for like an ultra high net worth individual or a family office that wants to truly understand what is blockchain technology and not only just invest for asset diversification, you don't actually learn all too much if you build up a position in a hedge fund. So you don't get that exposure to the founders. You don't get more knowledge. You have a different exposure. You have an asset diversification, but you won't learn much from that fund. We get through Polychain we get like quarterly reports, but it's more a report based on what are sort of like long-term trends. But it wouldn't necessarily help me as a traditional entrepreneur if I had like businesses for like 150 years in a certain industry to understand how will this now significantly impact what I'm doing, and how should I maybe pivot or build this technology into my running business in order to be ready for the future and not get disrupted by some startup that just raises a lot of money and then takes away all the business from me. So in that sense, I think from an investor for diversification, look at like the fund terms. That definitely makes sense. Also to see like what's the reputation, the background of the team running the fund. But if you really want to understand what is happening, then I think a fund is probably the wrong vehicle to invest into.
Yeah, I would agree. For my partner and I, for all of the investors that we've been speaking to, our commitment is to meet with them twice a year and actually tell them what we're learning for exactly that reason. I guess I would add a couple of things. Most of these funds are startups, right? And one of the things to really look at is who are the team and what is their actual investment experience? How experienced are they in building a portfolio? What is their approach to cryptocurrency, and how do they expect that to change over time? These are all very important things. Also, one of the things that you hinted at is look for alignment, right? If you are aligned with your fund managers, and what I mean is if you make money, they make money, that's a good thing. Some of these offerings that are online, some of the tokenized funds, they actually take an awful lot of money right at the entrance. And that's a very bad idea, right? What you want to have is the investor to make money and have a high hurdle. In our fund, for example, the hurdle is 20% per annum. So the first 20% we give to our investors, and it's exactly because you shouldn't be investing in these assets trying to make 13 to 15% a year. You should be investing in them because you believe in the transformative nature of the technology, and you expect that things will grow 3, 4, 5, 10, maybe even more times over time. And the other thing I would say that's very, very important is in any fund, the fiduciary duty that the manager of the fund feels is absolutely critical, but especially in cryptocurrency because the opportunities for abuse are much greater, right? In a regular fund, whether it's a private equity fund or a public fund, the ability to send the assets to yourself and then disappear with them is much harder. You have administrators and banks, and all of this stuff can be unwound. But obviously in cryptocurrency, where most funds are using their own cold storage, you have to be very confident that you have a complete level of trust in the people who are managing your investment. One of the things that's interesting to me, and that we can also talk about, is many of the investors that we've been speaking to in last year, they would look at us like we were crazy when we presented them with the idea of having a fund, because they said, why don't I just buy Bitcoin and I'll make tons of money? I think the last few weeks have taught everybody that there is actually a tremendous benefit to having a diversified portfolio and having professional fund managers who spend all of their time looking over the portfolio, and I think that's another important thing.
I think it's also important to look into it, whether the fund is long only or whether you can actually short in with your positions as well, and whether it can flip into fiat and so what's really the fund strategy if you try to select a certain fund, and I think as you mentioned, like the last few weeks, probably there's probably going to be funds that will significantly outperform the market, but on the if you look at the past 12 months, I think like a Bitcoin Ether 70-30 mix probably would have outperformed most of the funds, right? So I don't know how you see this, whether like an active managed fund in crypto is now can significantly outperform sort of the overall market trend of like the top coins, or how do you see this as sort of like an investor wants to get exposed?
So our approach is very different. In our portfolio, no position is more than 15%. Bitcoin is 7%, and we actually 20% outperform Bitcoin. So that our view is that you actually need to be more diverse. I think one of the challenges, of course, is that none of us can say with any confidence how correlated these assets are. Especially last year, things seemed to move almost entirely in concert with Bitcoin. But over time, it'll be interesting to see how do the Bitcoin forks correlate one with the other. or will we see them begin to perform independently? How about ERC20 tokens? Are they going to be moving lockstep with Ether, or are they going to actually have their own ability to move? And we just don't know the answers to those questions. One of the things that we were also asked to talk about is some of the structuring challenges for setting up funds. Maybe I'll start here because our fund is a little bit different than yours in that we actually have set it up. I would say there's tremendous challenges for us as fund managers. The first is there's almost no institutional infrastructure. The entire ecosystem for Bitcoin was set up for individual investors. So when we look for an exchange or any kind of a liquidity aggregator or a brokerage, we're looking for somebody who's able to give us a institutional product. And what we mean when we say that is, first of all, that they are a legal entity. Many Bitcoin exchanges are set up without the benefit of a legal entity. We also look for a robust KYC process for them. For those exchanges, and as you probably know, there are many, that allow people to open an account with just an email, we won't play there. We also look for people in these enterprises that actually answer their phones and are able to answer questions, because when you're managing somebody else's money, you really want to be sure that you have a high level of interaction. And almost all of this is absent. So one of the things that we spend an enormous amount of time on is constantly reviewing exchanges, contacting them, and also even helping set up exchanges. Second thing that's really hard, as I'm sure many of you appreciate, is if you're running a fund and you plan to return fiat money to your investors, then you need to have a bank which is comfortable working between cryptocurrency and fiat. And that's a very big problem here in the market, as I'm sure many of you know. And on the flip side of that, once we do get that infrastructure set up, it provides a great benefit for high net worth and family offices, because if they don't have a fund, once we have a fund, and our fund is in the Cayman Islands, it's a regulated fund, we have a regulated manager in the UK that is managing the fund, and we have an administrator which provides quarterly reports to them. Now those reports will allow them to take distributions from the fund into their bank account, whereas if they were to buy $1 million worth of Bitcoin and double their money, the bank might not take the money back. And even if the bank takes the money back, it's not entirely clear how they establish for the tax man what their basis is. So there are many benefits for institutional investors to come through another fund and leave all of the problems and headaches of banking and basis to the fund. And then finally, one thing more, which is a huge headache for us and is really the most frightening thing about having a fund where we take third-party money, is that we have to cold storage the cryptocurrency. And for us, this is a really scary thing. Neither my partner and I come from the technical world. We do have a full-time employee who is a really good technical guy who's been working with my partner for 10 years, so we completely trust him, but we've spent literally weeks, sitting and talking about how are we going to create this framework to store cryptocurrency. And I hope in the next 18 months or so, we'll see institutional opportunities for us to work with depositories that are fully insured and licensed, and then we can forget about this. But for now, if you're looking to structure a fund, you're going to have to spend a lot of time with the technical people figuring that out.
Yeah, I fully agree, and I think there's a big need for a fully regulated crypto bank, especially for exactly these services, right? There's a need in the market for institutional grade custody services for exactly these tokens, not only for funds, but there's also, there's now ultra high crypto net worth individuals, right? So it's there's people that have a lot of money on their treasures and on the ledgers, and I think it's not, we keep on losing bitcoins in the world, so I think it's not a very good solution, and I think also we need a bank that the whole establishment is sort of like fighting now that channel, right? Is now we can't buy bitcoins with credit cards anymore. Banks are cutting any sort of transactions that come from exchanges then to bank accounts and they're cutting these transactions or send the money back. And I think we need a financial institution that is regulated under the existing current system in the financial markets with all the licenses, with all the approvals that can allow the KYC, the AML, and all these processes, that is a player within the financial system that then offers these services to funds, ultra high net worths, but then also to sort of like the normal trader that has exposure in crypto.
Yeah, and for those of you who were here a couple hours ago when we had the conversation about altcoin, one of the things that doesn't matter to us as fund managers at all is whether any of these service providers are decentralized or blockchain based. What we really want to be able to do is to meet the obligations we take from an investor when we ask them to give us their money and their trust and to invest in them. So, it's an interesting, it would be ideal if there were a decentralized depository running on the blockchain that was fully secure. But in the absence of that, we're fully happy to take a centralized service provider. Because there's so many of you and the panel is smaller, if there are questions, I'd love to open it up to questions because we'd be happy to answer your questions.
So what are the 4 factors you guys look into before you decide to add that coin to your fund? 4 factors.
Thank you. So if I only had 4 factors, I mean, well, first of all, we have 3 different buckets in the fund. So we have 35 to 40% of the most liquid cryptocurrencies. Again, we limit ourselves to 15% in any one position, and most of our positions are under 10%. So in each bucket, we have a different view. In the cryptocurrency buckets, what we're looking for is liquidity and velocity, which is the amount of transactions they have. Because this is a very emotional market, we look at what is the market perception of it. Obviously, Bitcoin is by far the best known and the most widely held, so it's an attractive thing to hold. But for the other coins, we also spend a lot of time trying to understand what are the elements, because very few of them have the volume of transactions that Bitcoin does. And so one of the things we try to understand is if their infrastructure and their design is going to be able to sustain a high number of transactions. And finally, I would say adoption. So, the number of wallets that are out there, the number of people that are holding the currency is an important thing. The other buckets we have are what we call use cases. And there what we look at is, well, first and foremost, is it an industry where we think blockchain and decentralization is meaningful? Then we look at how does the actual token here function in its economy. And the easiest way, the shortcut for that is if you could substitute that token with Bitcoin or a dollar, then it's not very compelling. But if there's something unique about that token and the way it works in its ecosystem, then that's interesting for us. There again, you also look at velocity, the number of users, and then in the speculative bucket, it's really just that, it's speculative. So there it could be anything from an exceptional team that looks likely to be able to execute. So that would be something like Omisigo. We think that's a super exciting team, and they will be able to achieve great things just because of their backgrounds and what they're doing. But sometimes it's just a really compelling idea that we haven't heard before.
For us, it's really the fundamentals that we look at. So it's really technology, the team. We invest into fundamentals in terms of like the infrastructure layer that we really focused on. We hardly ever do dApps. So it's really the protocols. It's we do some of the security identification. We have some, I'd say, like long-term bets, like Singularity Net, for instance, was one of them that we quite like. But these are like sort of like the longer-term bets. But I believe we were still in this whole ecosystem. We're still in the early stages. We need the infrastructure first. We need to have the scalability, the interoperability, and these are like the topics that we're quite excited about, because we believe that in absence of this layer, everything else is sort of at risk, right? And Once we've tackled these challenges, and there will be solutions that successfully will solve these challenges that will probably be quite valuable going forward, then we can only move to the next phase and then also move into more maybe consumer facing applications that then build on these platforms.
Thanks. Could you comment on your storage situation? So do you use a third-party custodian? Do you store it yourself? If you store it yourself, do you use a multi-signature wallet? Like, what kind of solution do you use there? How do you distribute the recovery phrase of your Trezor? And how does the regulator look upon the storage solution that you currently have?
Well, it's a good question, and again, we spend a lot of time thinking about it. We don't have to deal with the regulator because we're in Cayman and they don't actually do it, but we do have to deal with our administrator. And actually, very interestingly for us, the auditor has been very active in helping us understand whether our procedures are appropriate. Everything is multi-sig, of course, as it would be even in a traditional fund. In the office, we have a computer that is used for crypto trading only. It's turned off when it's not trading, and its primary function is to communicate with exchange, either to put money to the exchange or take it back. Once we get it into the computer, it goes offline. We put everything on a multi-sig ledger wallet, and then we have a cold storage in a separate facility where we own our own server, and that server is entirely encrypted. It only can talk to a specific number of machines in a specific place. So the ports that it uses are very unusual, so it can't be attacked. And in addition to all of that, we also have a mirror site. The main site's in Russia, in the EU, which allows us to be sure that if anything physically were to happen, both to our office and to the cold storage in Moscow, we would have another place. It also is a bit of a hedge regulatory, so if the Russian government were to say you're not allowed to legally send crypto, we would still have a cold storage in a different country.
Hi, I have two set of questions. First question is regarding the LPs. So do you think for the current stage or last year, this year, do you think there is a possibility that you could get money from the more like a public entity kind of money, the national pension funds or the endowment kind of fund, or do you think it will be strictly limited to the money of the high net worth individuals where there is any possibility of extension of the LP pool? That's one question. And two questions is because what you're managing activity is unique skill set could be for a certain level of GPs. So do you think the GP compensation 220 that arrangement could be uniquely different from your previous management that you just manage money in a traditional way? So my two questions is LP characteristic, will they change? And number two, GP compensation, will they change?
Right now, most of the people that we're talking to are managing their own money, whether it's a family office or a multifamily office or wealthy individuals. Institutional investors are generally not ready for this, and they might be willing to invest, but we don't even expect there to be any kind of traction there. And even if there was, because our fund is new, we wouldn't expect them to. So, even if in any, whether it's a private equity business or more traditional assets, most institutional investors are looking for GPs who have a track record in that asset for a period of time. So even if institutional investors right now were coming into this, which I don't think they are, then we would expect them to be looking for people who had 18 months or 24 months of audited track record before they would do it. Is that your experience as well?
Yeah, I mean, and normally for institutional investors, I think it's even like 5-year track record, which is kind of hard in this space. But yeah, I agree with you. I think it's too early to really see like pension funds or like any other sort of institutional investors come in. I think family offices and ultra high net worth is really the space that we're currently in. With regards to GP compensation, I'll leave that up to you to comment on.
Well, I will say one other thing that's very interesting. We do actually speak to a lot of banks and institutions in general. And even the private banks, many of them have said to us, we're not going to officially represent your fund. We're not going to introduce you officially. But all of our clients are really interested in that. Do you mind if we set up meetings? And of course we say, no, we're happy to have the meetings. As far as compensation goes, our fund actually, and you can laugh, but it's a totally strategic thing. Our management fee is 1.9%. And the reason it's 1.9 is because many investors screen at 2. So just to not get off, we put 1.9. That said, for large investors, it's a negotiation. It's a conversation. So if somebody were to bring us, $20 million and say, I really don't want to pay you 1.9%, we would happily say, you can pay us 1% management fee. But that's really not meaningful. What is meaningful is the carried interest. Again, as I said, in our fund, the first 20% each year we give to our clients. So we will not, if the fund generates 19% per year for the next 3 years, we will not make any money. And that's fine. But there are many funds out there that actually charge more than 20%. Some charge 25. So I think it's really true. I think over time, we will see, and we have seen, a reduction of the amount of carried interest. But I also think that cryptocurrency is an interesting exception in that many of the places where people invest through hedge funds in the US market and more developed markets, it's becoming increasingly difficult to make the case for active managers making 2 + 20. So I do think that will start to come down. That said, the amount of investment that we put in before we even have our first investor dollar and the amount of brain damage we need to go through for this asset, to me, it seems like it's one that justifies having an active manager and one who is compensated appropriately.
Maybe on that point, just to add, I think the fees will come down dramatically because I think lots of it will be mapped onto smart contracts. I think lots of it can do like algorithm based, or there can be like software can actually replace what many of the fund managers currently do, which is build up a long exposure and then basically rebalance on a monthly basis. So I think the charge 20% on that, I think is ambitious, and I think that will have to come down. But I think for the time being, well, it's same in private equity. I think that will also get mapped onto a smart contract. So I think there will be disintermediation, and in the midterm now, it's already more competition because more and more funds. But I think over time, these fees will come down, in my opinion. It will probably take another 5 years maybe, but I think more and more will be mapped on the blockchain.
Yeah, and one thing to keep in mind is that being conscious of fees and understanding how they diminish your returns over time is important. But nothing replaces performance. So to choose a fund because you're getting 2 or 3% less of a burden on the carried interest is not the right thing. Pick the partners you trust and you think are going to give you good returns, and you'll be happy to pay them for the service they provide.
You mentioned missing infrastructure, regulatory and banks. Do you see any jurisdictions that are more advanced and are closer to get to a more standardized?
Sure. I mean, where I see the best infrastructure right now, there's a lot of interesting things happening in Zug, in Switzerland. And one of the interesting things about Switzerland is because of the cantonal system, there's competition amongst the cantons for this activity. And I think this competition to try to bring this new world of financial activity to various financial centers will be a driver of regulatory freedom. Obviously, Japan has licensed exchanges, which is a huge benefit to investors and will likely drive pretty substantial participation by institutional investors. The Cayman Islands is very actively courting the crypto community. There's also, it's less credible to me, but it could happen. Puerto Rico is now making a very strong attempt into it. And I would not be surprised to see the place where I live, Russia, also move to legalize institutional participation in the crypto markets.
Hi, I have a question. Last December, Wall Street's Goldman Sachs actually announced that they'll be setting up a Bitcoin trading desk. What does that mean? Would that mean that more institutional investors will be coming through them? And secondly, are you aware of whether it is already in operations? And thirdly, what kind of, how much of money do you think or you forecast it will actually bring into the market? Thanks.
Well, I think it's a substantial thing, but I take it as more PR than anything else. Goldman Sachs, which is a great company and has a lot of smart people in it, and I'm a shareholder, is really a hedge fund with an investment bank on it. So what I think it means really is they want to start understanding how this works, and my guess is they'll initially be doing it with their own principal capital. It's hard for me to understand how they could legally trade in most of the jurisdictions with their clients on their desk, but what I would expect for them to do in terms of bringing the market forward is, one of the things that generally happens with these guys is they set up a trading desk and then they start selling derivatives. And that wouldn't surprise me at all to see them begin to play in a market which is totally legal for them and where they could really make a splash.
Yeah, I can't really comment on this because I don't have any inside information on Goldman. I think I don't even know whether it's prop trading or whether it's on behalf of clients. So yeah, I can't really comment there.
If we are to enter a bear market in traditional capitals market, what sort of effect it might have on cryptocurrencies and the price of Bitcoin especially? We've seen amazing bull run in traditional capital markets with S&P breaking all-time highs every week, and now there's decline. There are indicators that the trajectory might be changing. So what is your opinion on what sort of effect it might have if we are to enter this bear market in traditional capital markets?
Well, it's a very interesting question. I think there's a bunch of things happening. I expect over the long term for cryptocurrencies to be uncorrelated. In other words, I expect them to act much more like gold and to be a place to run to when the markets go down. That said, what's happening in the U.S. markets and the rest of the markets as they follow is following on the heels of a big fall in the crypto market. So I don't expect that to happen in the short term. People are not used to rushing to the markets, and all of us know how difficult it is to actually get Bitcoin or Ethereum. It's not the same as calling your broker and saying sell or buy. And so this sort of difficult gateways and the absence of really useful user interfaces for people who are not technologically adept is going to make that flow much slower. I would say one of the interesting things that's happening is, and this is, I think, in part driving what's happening in the Western markets and the public markets is, we've had this amazing boom of liquidity that was provided mostly by central banks, and that's being unwound. And so, we've been living in an enormous oversupply of all kinds of sources of investment. And as that trade gets unwound and liquidity becomes tighter, I do think it will have an impact on crypto markets, and probably a very good one, right? Instead of 40 ICOs a month, maybe there'll be 2 or 3 quality ICOs a month. And so that's what I see.
So I have another question. Yesterday in the same room, I was discussing with another panel the shift from utility to security tokens, correct? So what kind of stand are you guys taking right now, or what kind of shift process that you are seeing that will happen from utility to security, and where do you expect the security token market to be 3 years out?
Yeah, I mean, there's a bunch of things there, and it's a very good question. Thank you. I think, the idea of a security token, right? The idea is that it has more elements of what we would consider a security, right? It has perhaps some form of management right, perhaps some form of participation in the profits of the company, and I think that's all to the better. There are actually quite a few interesting offerings out there that differ from most ICOs in that they have these elements. That said, I'm really skeptical that a lot of ICOs are going to be able to navigate in any of the established markets the securities and exchange rules that they have to deal with. So I'm not a big believer in the difference. I have an ICO for an algorithm company called Trading Gene that we're doing now, and we have a utility token, and we spend a lot of time with the lawyers and thinking about it. But the primary driver of that is to avoid this additional burden of having to register the securities. My own view is that the established markets have gone too far to limit the ability of people to raise money from accredited investors. It's just too hard to do an IPO. It's too expensive, and that I expect us to end up somewhere in the middle. So there'll be some kind of a increase in the quality of ICOs, especially in terms of the obligations of issuers to disclose information both at the time of issuance and going forward. And I also think that we'll see, some opening in some of the more established markets as they come down to meet this in the middle. It's going to be a process. But when we look at an ICO, it's much more important to us to understand, the fundamental question really is, if you own equity in the company, it might be interesting, right? But would you want to own equity in Bitcoin Foundation? I wouldn't. There, the underlying value is all in the token, right? But very frequently, it's the opposite. You can buy a token for a company that's going to make a lot of money, but you might not have any value in the token. So we spend a lot more time trying to figure out where is the actual economic value going to be generated rather than what kind of a token is it.
To me, I think the security tokens is actually quite interesting, and I think going forward we're going to see a lot of assets that will be tokenized that then probably will be declared as securities. And I think it's a very different sort of use case of the blockchain and the tokenization from now, because now we issue tokens in an ICO in order to raise capital. But I think further down the road we're probably going to see a tokenization effort in order to create liquidity, in order to increase transferability of certain assets. We can have much smaller pieces basically of an asset. You can tokenize a cow, for instance. You can do lots of different things that previously you couldn't do, right? And I think then suddenly you have asset-backed tokens, which I believe will be very, very big. And starting with real estate, which definitely makes sense. But then there's all sorts of different categories and current assets that can be tokenized and can be offered then to investors, which has a very different reason for tokenization compared to as of now when we basically do an ICO in order to raise capital for a business.
Yeah, and one thing that we haven't talked about, but that it seems to me is true, is that one of the things driving the ICO market at present is that you have a lot of people who began mining or bought cryptocurrency years ago and have an enormous amount of their net worth in Bitcoin or Ether or something similar. These people may not have an avenue to return it to fiat. They might not be able to get the money in their bank. Even if they do, they'd have to pay taxes. And so some of what's going on appears to me to be people just saying, I have too much Bitcoin, I'll diversify by throwing the Bitcoin at some ICOs and thereby diversify myself. And to me, that's how I understand some of the sort of nuttier ICOs that seem to be able to get a lot of money. These are people who, they may have invested at some point $10,000 or $15,000 and they now have several million. And so for them, if they invest in an ICO and they lose it, they're still stuck on their $15,000 valuation. They don't realize that they're actually investing $150,000 or something. So I think that's also fundamentally going to change. Are you? Sorry? No, this is not you.
The second set of question was, where do you see the market being valuing 3 years out? Crypto. Be it utility or security, you guys are hedge funds. I'm sure you guys have cash flows. You guys have projections. I'm sure you guys have done the numbers. So where do you expect the market to be 3 years from now?
First of all, 3 years is entirely too long a horizon to have any kind of expectation. So we don't know. I mean, I don't have a lot of conviction about this. If tomorrow Bitcoin were $15, that wouldn't surprise me that much. If Bitcoin were to start rising and go to $150,000, that also wouldn't surprise me. What we try to do is to understand what's happening and constantly challenge our own beliefs. So, what's going to be happening 3 years out, I don't know. I can say that I think we're going to end up, 5 years or 10 years from now with 5 or 6 major cryptocurrencies, just like we have the 5 or 6 major players in the internet space. My guess is that 1 or 2 of them will be sovereign cryptocurrencies that enter the market. But beyond that, I have no idea. We're in the very earliest stages. We're in the 2nd generation of blockchain. There are all kinds of problems with the Bitcoin blockchain and Ethereum that will be solved. And so to try to guess what's going to come, I think would be to just sort of take away from the constant analysis that we need to be doing.
11 trillion. I'm kidding. No, but I'm very bullish on the long run in terms of like total market cap. How many assets that will contain of, and which one will win, and whether like the top 10 will make up 90% of the market, or whether it's like fairly equally spread. I don't know. It remains to be seen.
You were 1 trillion ahead of me. I had 10 trillion.
Yeah, and one of the things to think about is when we look at the overall capitalization of cryptocurrency, we compare it to global M2 of fiat money. So in other words, we say right now, if you look at the overall capitalization of all of the cryptocurrencies, we're at about 0.3, 0.5% of global money supply. So for me, it's much more interesting to understand, I'm almost certain we get to 5%, so that 5% of all the money in the world will be cryptocurrency, and that is 10 times where we are now. So I'm comfortable enough with that to go. Which currencies it's going to be, I haven't any idea yet.
Hi, thanks for talking about your fees, but what are your investors expecting in terms of performance, since cryptocurrency's been exploding since November in valuation? You can basically pick anything and still possibly 4x, 6x, and 10x. So if you're charging these 20% or 2 and 20 or 1.9 and 20, what are you telling your investors that they should expect in returns from you guys? And how did you come up with that figure?
So, first of all, we try not to promise anything to our investors. We try to get them to understand what is the philosophy, what we're doing. The way that we look at it is, we expect if you were to invest with us over 5 years, it's entirely likely that 3 of those years you might not make any money. And you certainly won't make more than the 20% hurdle. But that 2 or 3 of those years, you'll make a multiple of your money, and that's the reason to do this. But to expect, again, anything on a 1 or a 3 year horizon, it's just not something that we want to do. What we try to do is to get them to understand this fundamental idea that as the overall capitalization of cryptocurrencies becomes a larger proportion of global money supply, if you have a proper portfolio, you will participate in that, multiple of whatever the capitalization is now, and nothing more than that.
I mean, it really depends, how long these investors are in this space already, and we had some like recent investors joining one of our SPVs, and they couldn't believe it, right? So we made like 100% within a few weeks, like everybody else, right? So it's if you compare it to like traditional asset classes, then like all the investors are like super excited. If they're in the crypto space now for a while, then they might have some sort of expectation, but I mean, past performance doesn't predict future performance, and so I think it's important to have like a comparison and a benchmark, and then try to outperform the benchmark. But yeah, I mean, it's hard to predict where the market will go. Yeah.
Yeah, and I would just add, it's very, very important that you invest the appropriate amount of your net worth in cryptocurrency. Right, we think 3% is a good number, 5% is, probably a maximum number, and the reason is it could go to 0. People always say, only invest what you're prepared to lose, but there's a non-trivial chance that this stuff goes to 0, and so you should be willing to lose that in your portfolio. Maybe it won't go to 0, you should be able to, But 3 or 5%, if it triples, is enough to really meaningfully change the performance of your portfolio for that year. And so that's how we try to get people to think about it. Again, the worst thing that could happen to this nascent and world-changing technology is if people start mortgaging their houses and buying Bitcoin. That's when it really gets out of hand, and that's when the regulators will be compelled to be even more aggressive than they are now. But if people are wise and put a little bit of their money in order to generate the big multiples when they can, then this is something that can run for a long time.
Thank you very much for your views. Could you please expand on your philosophy investing into protocols, technology versus dApps businesses?
Why we're bullish on one and less bullish on the other? It's basically we believe that currently we don't have the scalability on any of the platforms that currently allow for like smart contract Ethereum, to really build dApps that could serve a large enough audience that then could turn into valuable ventures on the long term. So if CryptoKittens manages to really kill the entire Ethereum network, then what happens if we really have a product out there that is being used for real use case and then just like stop sort of all the other applications that maybe also want to build something meaningful. Transaction fees go through the roof, and then that just impacts all the businesses that build something on Ethereum. These problems are being addressed, and it might be that Ethereum managed to solve these challenges and really stays on top of the game. But then there's other platforms that are being built. They don't it's not Tzorya and open heart, but they actually built something from scratch, and they already solved part of these scalability issues. We're also quite bullish on interoperability. That also solves a bit of the scalability challenge. So it's more on like providing like this fundament. It's if you want to build a skyscraper, you should make sure that your fundament is really really stable and strong before you sort of invest into the company that provides the furnishing for your living room. And so that's a little bit how we think about it. So we have multiple bets on different infrastructure plays, infrastructure as in like blockchain infrastructure, because we don't really know which one will come out on top, but we believe that the one that will come out on top will be performing and returning a lot better than a dApp that builds now on a protocol that might be stuck with sort of the losing or like the not the winning end of the platform.
How do you deal with the volatility in the market, and which hedging instruments do you use?
We do not hedge, and really, again, it has to do with the infrastructure. The only hedges that are meaningfully available right now are naked hedges, right? They're basically directional bets that you can make, on CME, and it's not to us that's not meaningful. Again, my experience is in the Russian market, which is also a market that until recently did not have any meaningful hedges, and we did the same thing there. People had to understand that the market could go illiquid, and really more than worrying about hedges, we worry about liquidity. How are we going to handle liquidity for investors when they approach us? That's a challenge that nobody can really provide the answer to. But given the absence of meaningful counterparties out there, and again, as institutional funds come, as commercial banks and other institutions start entering this, then it will be possible, and we'll be much more interested in hedging.
Firstly, thanks for sharing everything from a place of abundance. Really appreciate it. Secondly, from someone coming from the crypto space who's been very privacy-minded, how may they establish trust with new investors that are outside their personal circle? And second part of the question is, are there any personal security concerns being a public-facing person of a fund?
Was that a threat? No, we don't really worry about that. We don't have enough funds under management right now to worry about it, and I hope that we won't have to. I think given the fact that everything in our fund is multi-sig, that we have an administrator, that we would be a poor person to try to bribe, because there would be nothing we could do anyway. In terms of investor trust, you know, I don't think crypto's any different. I think if you're giving your money to somebody to invest, you should trust them, and you should trust them not only to not disclose that they're investing with you, but you should trust them to act as a fiduciary and always act in your best interest, even if it might not be in their own financial interest. So to me, there's not the element of cryptocurrency doesn't change very much, the trust element.
I agree. More questions, or we run out of time, I guess. Yeah. So.
Thank you very much for your attention. If you guys have any more questions, we'll be up here.